Dear members, good evening. Yeah. I, Tupar, Secretary, on behalf of the Management Committee of Bangalore Branch, welcome you all for this study circle meeting on IND AS 115, revenue from contracts from clients, which is navigating revenue recognition for CA profession. To speak on this topic, we have our own CA Kaleshwara Prasad. May I request CA Lakshmishan to escort the speaker to the dais and request you to please greet him with the floral bouquet. Let's have a round of applause. Yes. Thank you. Members, it's a privilege to introduce the speaker, Mr. Kaleshwara Prasad, FCA, CSAT, LLB and Diploma in IFRS, UK. He is a chartered accountant with 20 years of post-qualification experience in financial reporting, auditing, taxation and consultancy. Founding partner at KSK & Co. Chartered Accountants, Bangalore, previously associated with the Deloitte, South Africa, serves as a technical reviewer with the Financial Reporting Review Board of ICI and a faculty member of ICI Bangalore chapter and on Accounting Standards Board. He is a regular speaker at ICI webinars and professional forums on accounting and auditing standards. Members, let's have a round of applause and welcome the speaker.
Good evening, friends. So we have a long time to go. So 3 hours is what we have for this discussion. Given the deadline what we have, so we have a deadline which is 2 days from now. So most of us were busy working. But having that said, we have our own requirements, and this study circle meeting and CP requirement is also one of the requirements. I chose this topic 115, okay, leaving apart the other standards. So in Accounting Standard Board, we do discuss accounting standard in days in detail. So apart from other standards, 115 I've chosen for discussion because in per se, I myself find it difficult. I myself find it has too many interfaces, too many linkages which if you start as a student, if you start as a learner, we forget where actually we are leading to. Okay? When I started, so compared to other standards where I'm able to easily link from one to another, even for the matter, even if you're talking about leases or any other standard which we feel comparatively tougher, 115 I feel so was more tougher to me compared to any other standards. So that is the reason I took this 115. The objective of the standard would be, basically, I'll keep the discussion in a very smooth flow so that as a beginner, we will make best use of 115. How do we understand the nitty-gritties of 115 in comparison to the earlier accounting standard? If time permits, we'll even see. If time permits, you people will be more experienced in GST and income tax. We'll even see how do we recognize revenue in GST and income tax. Okay, so let us see how it goes on. So the objective is basically to understand the revenue recognition. So each word we will go in deep and try to understand the meaning out of it. Then, before we enter into 115, we will see what are the comparative standards in accounting standard, which is 9 and construction contracts. Then we will go step by step into 5-step model which is provided in 115 with respect to revenue recognition. Few special cases. So we have a warranties, we have a bill and hold, we have a agent and a principal. So standard does talk about all these aspects in detail. So we'll try to understand few of the nitty-gritties. Toward that, we'll also have case studies to understand in real life scenario given us thing, how do we basically do a revenue recognition. So this is going to be the agenda for next 3 hours. So I'll try to keep it friendly manner. So if you feel somewhere if you require detailed explanation or more explanation, please point and we can have it discussed. And if I lack something, you can feel free to add. So let us make it a joint exercise. Let us not make it a one-sided exercise. Let us make it a joint exercise so that together we learn this Ind AS 115. Okay. Revenue recognition, wherever it is, whether it is in accounting standard or Ind AS or income tax, GST, I'll take it up a little later. You can do a revenue recognition provided these 3 criteria are fulfilled. Without these 3 criteria, we will not be able to do a revenue recognition. Okay? One is performance. The entity, the service provider, should have performed what is expected to do. So that is the first requirement. It is there even in Accounting Standard 9. It is there more detailed in Ind AS 115. It is there even in the income tax, income computation and disclosure standard. Performance is the first and the primary requirement. Okay. Having said that, just because I perform my obligation or supply goods or services as the case may be, am I good to recognize revenue? No. The second important thing is collectability. If you have an uncertainty in relation to collection of a revenue, then you are hit. You cannot recognize revenue. Okay? One is, I should have performed my obligation. That means I should have supplied my goods and services as per the requirement. The second interesting thing is, I should not have any uncertainty with respect to collection of a revenue. Okay? The second interesting thing. The third interesting thing would be measurability. Especially, any guess which standard specifically talks about requirement of measurability? AS 9, when it talks about recognition of a interest, royalty or a dividend income, it clearly says that you are expected that income should be measurable. If you are not able to measure the income properly, to that extent you will not be able to recognize the revenue. Okay? So these are the critical things before we venture into the standard, whether we are venturing into accounting standard or Ind AS or income computation or disclosure standard, we have to ensure these 3 parameters are fulfilled before we start thinking of a revenue recognition. Day 1, we know how do we account for a revenue recognition. Revenue being a income, credit side. Debit, if you have received a bank, if it is receivable, then we are going to debit it as a debtors or a receivable as a case may be. Okay? So important thing, for a revenue recognition, you need to ensure that it fulfills the performance, which is basically from an entity perspective or supplier perspective. Then the collectability, I should not have any uncertainty in relation to collection of a revenue. Third one is basically measurability. I should be clear when it comes to what extent I can measure. Okay? So we always have a complication when it comes to like a 5-year fixed deposit where interest is accrued and paid at the end of 5 years. Very interesting aspect. How do you recognize year on year? Even though the standard says, if you have an uncertainty or if you have a challenge with respect to measurability, to that extent it gets postponed. Okay? Again, a word of caution here. We will be talking more from an accounting standard perspective. When it comes to income computation, so there you will have a different sections which come into picture, which results in admissible and inadmissible, wherein your income for income computation could be totally different from the income what you would have recognized in the trading and profit and loss account. So that factor we have to be very clear. Are we okay with this? Yes. Revenue recognition. So 115 is what we are supposed to start with. What is the basis in accounting standard? We have two bases. One is AS 9, which per se talks about revenue recognition in relation to supply of goods or services. In addition, Ind AS 115 is so vast that it even covers revenue recognition from a construction contract. So, we have to have a clear knowledge or a understanding with respect to both the revenue recognition and the construction contract, so that our journey with respect to understanding 115 becomes easier. Okay? So AS9 is revenue recognition, AS7 is basically construction contracts. Put together is what is dealt in 115, and that is what we will have to discuss. We'll spend a very quick time with respect to AS9, and then we will AS9 and AS7, and then we'll start our discussion as told earlier. AS9 talks about recognition of a revenue. Okay, I have one more interesting question. What is the difference between revenue and an income? What is the difference between revenue and an income? In accounts, we call it as a revenue, but when it comes to computation and disclosure standard, it's called income computation and disclosure standard. Why have they not called it as a revenue computation and disclosure standard? Any thoughts?
Income is a much broader term.
Super.
So income includes income from the sale of a fixed asset or income from any other source. So revenue refers to its primary activity.
Very, I think, is answered to the dot. Income is a much broader terminology. It includes a revenue. In addition to, we will discuss what is revenue a little further. In addition to revenue, it also includes other aspects which will increase the assets or which will decrease the liability. End result is your equity component get added. What are the other aspects through which this can happen? Government grant. If you receive a government grant, okay, that's one thing. Appreciation of an asset. Appreciation of an asset. Fall in the value of a liability. I am supposed to pay a liability of say 25 lakhs. I end up paying only 23 lakhs as a full and final settlement. Again, an income. Okay. So all put together is a income. One of the component of that income is the revenue, which we are discussing. Having understood income, let us see what is revenue. We have to be very, very clear. Revenue from ordinary course of business activity. Okay. So one would have easily said government grant I will receive. Every now and then there is an appreciation, revaluation. There is a bargain and negotiation which we follow for settlement of a liability. So does this happen on an ordinary course of a business activity? If that were to be an ordinary course of a business activity, then the implication would be different. Revenue, most importantly, should result or should be the outcome from ordinary course of a business. What is ordinary course? For a retailer, buying and selling is an ordinary course. For a developer, okay, developing or constructing a building would be in the ordinary course of a business. Yes or no? I think we are very clear when it comes to ordinary course of a business. Only from an ordinary course of a business, if you are able to generate, then that is called as a revenue. It further says revenue from sale of a goods or rendering of services. So it is not just restricting to a trading activity, it even encompasses service sector, sale of a goods and rendering of a services. In addition, beautifully it says, if entity by usage of its resources, if it's able to earn interest, if I have a surplus money, I park it in a bank, I get an interest. Even there also it ventures and says, how do you recognize that? Royalty, I have a right through which I am able to earn a royalty. Dividend, I have invested in an equity in some other company which I earn a dividend. So in addition to recognizing revenue from an ordinary course of activity, basically from a sale of a good or a rendering of a services, it also says how do you recognize your income in relation to interest, royalty and dividends. So these are the things which has been covered in accounting standard 9. So without wasting much time, what it says with respect to sale of a goods, it says when you have transferred or when a significant risk and reward in relation to the goods have been transferred to the buyer, that is when you can recognize revenue. That is when you can recognize revenue. We'll take it up a little later. What is significant risk? What do you mean by transfer of a significant risk and reward? Okay. The other aspect, I'll pause for a minute. Collectability is reasonably certain, because if you remember the first slide, we said collectability is one of the primary requirements. If you fail the collectability, you will not be able to recognize. Okay. Performance. What is performance? Supply of a good or a services. When it is deemed to be completed, when the significant risk and reward in relation to the goods or thing has been passed on to the buyer, so that is when you said that sale of a goods is completed. Rendering of a services. Rendering of a services. Basically, this standard is the only place where you will find this dilemma, where it is giving you two possibilities: proportionate completion method or a completed service contract method. If you have taken up a concurrent audit assignment, that means every month we do an audit and we even raise an invoice. So, proportionate completion method, even though my contract is for a period of 12 months or whatever, 3 years or the case may be, when am I expected to recognize revenue? Proportionate completion method. Completed service contract method. A statutory audit. Okay, a statutory audit. We are doing a government audit. We have issued a report. Okay, the management is saying, this we are still to get a clearance from C&AG. We'll clear your dues, your invoice once we have a clearance from C&AG. So I thought, where does the completion end? So that's on a lighter note, but coming back to this, only this is the place where you have two possibilities of recognizing the revenue: proportionate completion method or a completed service contract method. So the other aspects, interest, royalties and dividend. So needless to say that I should have passed the collectability and measurability test. Only if I pass the collectability and measurability test, I can go ahead and do a recognition. Interest, I can recognize based on a time basis. So the previous example, FD kept for a period of 5 years where interest is accrued. So you will have to work out and see what is the time proportionate basis for recognizing the interest. Royalties, you can recognize it on a accrual basis. Dividend, when you have a right to receive dividend. When you have a right to receive dividend, that is the time when you will recognize the dividend. So this is one aspect of ES9. I will not dwell deep into it. I require you to pay attention when it comes to rendering of a services. I'll repeat, this is the only place where you, in accounting standard, we have this possibility of proportionate completion method and a completed service contract method. Surprisingly, you do not have this when you move on to accounting standard 7. Accounting standard 7 talks about only percentage of completion. It doesn't talk about completion. You recognize revenue at the end of a completion. Okay. AS7 talks about construction contracts. How do I recognize revenue? Based on a percentage of completion method. Percentage of completion. Very interestingly, how do I ascertain the percentage of completion? My weightage will fall back on the cost. How much is the cost which I have spent in comparison to the overall cost? So that will help me to ascertain the percentage of completion. So once I know what is the cost as incurred in relation to the overall cost, which might be 40%, 60%, 75% of the case may be, I am expected to recognize revenue to that extent, 40%, 75% of the case may be. Okay. Outcome estimate. So cost recognition becomes the primary factor for us to ascertain the percentage of completion. Outcome. If a contract outcome can be estimated reliably. Okay, you can go for a percentage of completion. If you are not able to estimate the percentage of completion, then again we fail on the virginal aspect as to what extent I can recognize. The standard comes to a rescue and says that you can recognize revenue to the extent of the cost what you have spent in relation to the contract. So that is one thing. Another interesting thing is basically a conservative approach. What does the conservative thing says? In case you foresee a loss in relation to the construction contract basically for a longer duration. It doesn't happen within like few months. It may extend to 2 years or 3 years as the case may be. Even though I am in the first year or the second year, and if I foresee a losses in relation to the ultimate contract completion, then the standard expects us to recognize the complete losses at the time when you realize it. So that is an expected loss purely based out of your conservative approach. Okay. How was the discussion? So we started understanding the 3 ingredients for revenue recognition. So before we ventured into 115, we spent some time with respect to AS9 and AS7 because clubbed together is what we are going to learn in AS 115. Any standard for that matter will have an objective, will have a scope. Scope is basically to whom it is applicable or to what extent it is applicable, to what it is not applicable. And then you have a applicability which we'll discuss later. Coming to the scope of India's 115. What is interesting is there might be instances when the contract or an agreement encompasses multiple aspects which includes both recognition of a revenue and other thing. What the standard says in general, wherever other standards are applicable to that extent, you bifurcate and apply the other standard, and only for the balance you apply India's 115. Okay? But in general, for the following things will not be invoke 115. What are those? Lease contracts. So we have a dedicated standard which is on par with 115, which is India's 116. Insurance contract. Is it 117? Is the standard named properly? Is it 117? Somewhere I remember reading 104. India's 104 recently modified to made it 117. The current standard would be 117. Then, in relation to financial instrument, 115 would not be applicable. In addition to financial instrument, whenever you have a revenue recognition on account of a consolidation, joint venture, associate, etc., the respective standard provides on how you are supposed to recognize. So, the 115 again would not be applicable. Non-monetary exchange between similar entities. One of the primary requirement of 115 is it needs to be with the end. It needs to be with the customer, not the end customer. It needs to be with the customer. Whenever there is a non-monetary exchange between similar entities, so standard gives a standard. This example is what we have been using from ages. If there are 2 oil companies, one in south, one in north. Because of the distance, they agreed to supply the same product to the customer. So the north company, if it wants the goods to be supplied to south, it will ask the company which is registered in south to deliver those goods. So those kind of non-monetary exchange between similar entities would not be covered under 115. Okay? Few definitions before we venture into 115. Contract. Unless you have a contract, 115 would not be applicable. So don't get into the thing that contract, agreement, those kind of a thing. In essence, there should be an agreement or a consensus between the entity and the buyer in relation to a supply of a goods or services. Okay? That is what a contract is all about. The customer, so this is only a definition, so we'll go back and understand the requirements of a contract a little later. Customer, Who is a customer? 115 is applicable only in relation to revenue recognition with respect to contract from customers. Contract customers. Who are customers? Customers are the one who obtain goods or services from entity in its ordinary course of activity. So, with a party that has contracted with an entity to obtain goods or services in the entity's ordinary course of business, that is going to be a customer. Revenue, we have dealt it earlier, so I'll pause that for a minute. Performance obligation is a new terminology what you find in 115 in India's regime. Performance obligation, simply put, is nothing but a promise. What is the commitment the entity has made in relation to its ordinary course of business activity? So those are the promises. So simply put, it is nothing but a promise. A contract can have multiple promises. So a standard expects the promises to be identified and accordingly recognize revenue. A transaction price. What is a transaction price? Transaction price is nothing but a consideration an entity is expected to receive. That is called as a transaction price. Okay. Contract asset and contract liability, I'll take it up little later. Standalone selling price. Standalone selling price. Let us understand this with a simple example. I buy a laptop with 1 year service warranty. Okay? I buy a laptop with 1 year service warranty. If I buy a laptop, it will cost me 30,000. If I buy a service warranty separately, that might cost say 2,500 per annum. So that is going to be the standalone selling price. If you were to buy something on its individuality, what is going to be the price you are expected to pay? So that is going to be the standalone selling price. This terminology will be used in quite often. Revenue and income we have dealt earlier, so I will skip that for a time being. What is left is a contract asset and a contract liability. So this opens up to a new thing, which is the contract asset, contract liability. So before that, let us see unbilled revenue. What do you understand by unbilled? Okay, revenue we all understand. So something which has been performed, which I have a right to receive, is a revenue. What is unbilled revenue? Any guess? What is unbilled revenue? No questions to be asked.
The effort which has been put. The effort which has been put, but the revenue
Cost is incurred, but it is not a
Okay. We are all working on a deadline. So till 31st, we don't even raise an invoice. What we'll do, we don't even raise an invoice. We would have completed audits, we would have completed filing. November 1st week, all of us will become busy doing what? Raising an invoice. Okay. Unbilled revenue, work has been performed. Only thing is you have deferred the generation of an invoice. That is an unbilled revenue. If I complete the work and I do a billing parallelly and raise an invoice, then that becomes my receivable. Are we clear? Unbilled revenue and thing, receivable. Are we clear? Okay. Contract asset. What is contract? Okay. Then we will go one step backwards. What is advance received? Advance received. Okay, in our profession rarely it happens, but if you say an advance is being paid in relation to a supply of a goods or services, you entity. So please note that we are all talking from perspective of an entity which has to recognize revenue, not from a buyer or customer perspective. Okay. Advance received. An entity has received a money in relation to supply of a goods or a services, which it has to do at a later point of time. As of today, as of that month end, as of that quarter end, when I'm supposed to do my financials, I'm not completed my obligation. No performance from entities, right? So those are advances received. Okay. Now comes the interesting aspect, which is nothing but a contract asset. Any guess what is contract asset? Any guess what is contract asset?
That is actually the cost part of some order.
Okay. We are clear with unbilled revenue, right? Unbilled revenue is basically, from our perspective, we would have filed tax return, we would have completed tax audit, we would have filed a income tax return. Okay. And only thing is, we are all busy with 31st deadline, so we raise an invoice in the month of November. That is unbilled revenue. Okay. Now extend the same logic in 30th September. What we have done, okay, the contract between the service provider and the customer is supposed to complete a tax audit and also file a tax return. Correct? Now that is the requirement for a lump sum fees of say 1 lakh. Okay. As on 30th September, what we would have done? We would have completed tax audit report filing, because that is the due date within which we will have to do. Income tax return we all know, so we have additional 1 month time. We have not completed tax return filing, which we completed in the month of October. Okay. The question is, on 30th September, I have completed tax audit return filing. That means to that extent, I have completed my responsibilities, I have completed my work. Can I recognize that revenue? Yes or no? The answer is yes, and that is called as contract asset. Okay. I'll give you one more example before we actually go to the definition. Construction of a house or a way, the requirement is the payment would be made after achieving a milestone. What is a milestone? They say 50% completion, you will be paid the first installment, 100% completion, you will be paid the second installment or the full amount. As at the period accounting year end, I have completed 45%. What I have completed? I have completed 45%. Have I performed a portion of my responsibility? Yes. Can I bill customer? Customer will say, boss, please get completion certificate of 50%, then I will make a payment. So the work what we have completed, that is called as a contract asset. We have completed, but we do not have a right to bill. Yes, we have completed our obligation, entity has completed its obligation, but it has not billed. So that is called as a contract asset. It cannot bill. So please understand, there is a lot of difference between unbilled and contract asset. Unbilled, I only did not bill. Okay. In contract asset, I am not in a position to bill. Okay. Since we follow a 5-step model, subject to fulfillment of other conditions, contract asset could be recognized. How do you basically recognize? Contract asset would be recognized, which is to the extent what you have completed, to revenue. Please remember, subject to fulfillment of other conditions. And when it actually becomes completed, when I reach that 50% milestone, that is the time when the contract asset will get credited and the receivable will get established. Are we clear? Contract asset, unbilled revenue, debtors or receivable as the case may be. Okay. I was going through the Ind AS financials. After having all this knowledge, I was going through the Ind AS financials. I was searching for the word unbilled revenue. I could not find it. Okay, I could not find it. For presentation purpose, unbilled revenue and contract assets are clubbed and presented as contract asset. Are we clear with this? So I was curious, after learning unbilled revenue concept, I went and started looking for unbilled revenue. So we don't find that in P&L or balance sheet. What we find it is, it will be grouped and presented as a part of the contract asset. Yeah? Can we move on? What is the core principle? So objective of 115. The objective of 115 is basically provide a recognition and measurement principle for revenue recognition from its ordinary course of an activity. So basically to provide principles for recognition and measurement. It talks about 5-step model, which we will understand in detail. Each aspect have to pass through this 5-step model, then only you can basically recognize a revenue. You remember the terminology? A revenue recognition from contract with customers. So the first step is basically identify the contract with the customer. So the first requirement is basically identify the contract with the customer. The second thing is identify, so first is contract, the second is how much promises you have made in the contract. Ascertain how many performance obligations in the contract. Third one, determine the transaction price. Ascertain what is, see, one, there is a contract. Second, ascertain how many promises or performance obligation are clubbed or bundled in the contract. What is the price for this contract? What is the price for this contract? The fourth step is split that price or allocate that price to the various promises. And the fifth is basically as and when you complete a promises, as and when you complete your performance obligation, you recognize a revenue. I think one slide is what we have missed. We have missed an interesting aspect. AS9 talks about transfer of risk and in relation to completion, in accounting standard we were talking about transfer of a risk and a reward. But in 115, basically the risk and reward gets replaced by transfer of control. So we will not be, 115 will be talking about transfer of a control, not the risk and reward. Okay? We need to have some understanding with respect to these two terminology. If I have to put it in a simple terminology, it's as thing as a revenue and an income. Income is a much broader terminology. Revenue is a component of that income. Transfer of control is a much broader terminology. Transfer of risk and reward is one component of it. Okay? We'll have to be very clear with respect to transfer of a control. Okay? Let us understand what is transfer of a control, which is the basis for our Ind AS 115. Okay? When you say a transfer of a control, when the other person has an ability to direct the usage and obtain the benefit from that asset. When the other person is able to direct the usage or control the asset. When I say control the asset, that means this laptop, I am controlling. What do you mean by control? I can stop others from actually using this laptop. Yes or no? Your individual laptops. So, if you are able to direct the usage as to in what methodology this particular asset, when I say asset, don't get confused, basically goods or services is what we are referring to. Ability to direct the usage of an asset and obtain the economic benefit from that asset, so that is called as a transfer of a control. When you can say that customer who is having the right to use an asset. So who basically has a right to use an asset. So that will determine whether the transfer of control has happened from entity to the customer or otherwise. Can the person who is having a right to control or the person who is having a control, can he prevent others from using this asset? Can he direct the way the asset need to be used? Okay? If you are able to say yes, that is when you can say a transfer of control has happened. Okay? Coming back to the risk and reward, which AS9 is basically talking about. When you say a risk and reward in relation to goods have been transferred, who basically will be responsible for the damages? Who basically will get a benefit for change in value or an inventory loss? So that is when we say the transfer of risk and reward. Okay? If I have to put that in a single line terminology, transfer of control basically talks about substance-based control evaluation. My AS9, which talks about risk and reward, talks about economic or a legal ownership. Okay? This is a major shift from accounting standard to the Ind AS regime. Accounting standard regime talks only about a transfer of a risk and a reward, but Ind AS talks about transfer of control. It is looking from an economic benefit. Whether the economic benefit, the person who is getting a control, whether he is able to get an economic benefit out of that asset. So that is the time when the control of an asset can be established. Okay, let us have a quick revision. Five-step model. So, identify a contract with the customer. Say, client would have come to us for tax audit as the statutory audit. So, we'll have to identify the contract. What is that the customer and the entity is obligated. So, it is basically in relation to rendering of a tax audit and a statutory audit thing. Identify the performance obligation. Identify how many promises an entity has made in relation to this. In the given example, performance of a tax audit and performance of a tax audit, statutory audit. Determine the transaction price. What is the overall consideration agreed for in relation to this particular contract, whether it is 2 lakh or 3 lakh as the case may be, overall consideration agreed upon. Step 4. Allocation of a transaction price. Out of the 2,50,000, which is a contractual price, how much should be allocated to a tax audit? How much should be allocated to a statutory audit? The step 5 is, as and when you complete your performance obligation, that is completion of a tax audit or a statutory audit as the case may be, you can recognize a revenue in relation to this. See how interesting it is. I may complete a tax audit much before, then I become eligible to recognize the revenue. I may complete statutory audit, they all got AOC 4 extension, so we'll wake up only in the month of December. So, statutory audit related compliances might happen in the month of December. The interesting aspect here is, the client might pay me in the month of, after completing both tax audit and a statutory audit. From an entity perspective, the moment I am able to complete a tax audit, I can recognize revenue. I might have not raised an invoice. Super, perfectly fine. Yeah, we are all busy. We are not able to raise an invoice, but I can recognize a revenue to the extent of fulfillment of my performance obligation. What is that I have done as of now? I completed my tax audit. To that extent, I can recognize revenue. So what is it we are able to understand? Billing or an invoice is not a criteria. Completion of an entire contract is not a criteria. Yes or no? Receipt of money is not a criteria. Still then I can recognize my revenue. Okay, I've been now getting into the interesting aspects of 115. So, now the entire discussion for next 30 minutes or so will only be in relation to understanding these 5 models. Okay, we'll only be spending time to understand these 5 models. If I am able to understand these 5 models, then my understanding of the standard becomes complete. Okay. Contract is a primary requirement Only when all the 5 conditions are fulfilled, then only you can say contract exists. Where are we? Let me just go back to a slide. This is one step in my revenue recognition. That one step has 5 conditions. Only when all the 5 conditions are fulfilled, then I can say I've completed the recognition of a contract. Then if other conditions fulfilled, then I can think of recognizing the revenue. Are we clear? What are the conditions in relation to identifying a contract? Okay, the first thing is all parties should approve the contract. So please don't have that thing formal writing, in writing, binding, all that. It is nothing. So both the parties should have a concurrence. If a client comes to us and says that we want a tax audit and a statutory audit, we do understand what we mean by a tax audit, what we mean by a statutory audit. So the client and the entity, or the customer and the entity, should have a consensus. Okay, so that is all parties must approve the contract. That means both are committed. The entity is also committed for performance. The client is also willing to have the services consumed and pay revenue in relation to that. Okay, the next condition is ascertain each party's right. What is, in the given example, what is the entity right here? In relation to tax audit, it asks for books of accounts and those kind of things. Basically, the support has to come from a client. So each person should be very clear with respect to rights and obligations. Third interesting thing, identify the payment terms. Identify the payment terms. Basically, we need to have a clarity with respect to the amount of consideration. Condition number 4, must have commercial substance. A new terminology, commercial substance. What is commercial substance? Any idea what is commercial substance? Okay. We have an interesting thing when it comes to a barter system. So even barter system, it talks about how do you recognize a revenue. But the question is, it should have a commercial substance. Any transaction for that matter should have a commercial substance. If it lacks a commercial substance, then it is not a contract. So what is commercial substance? A profit element alone is a criteria? Is consideration alone a criteria? I have a Samsung phone. Sir, as an Apple phone. Okay. If we swap, barter system, if we swap, okay, can you say that it has a commercial substance? Okay. Fine. Mr. A has got Apple S14. Mr. B has got Apple S14. If they swap, okay, one is black in color, one is purple in color. If they swap, are you able to understand the difference between these two? One is Samsung for an Apple, one is Apple S14, one is change in color, pink and black. Okay? So where were we? So first, exchange of Apple, pink and black. Do you think it has a commercial? It has a commercial substance?
Oh, second is a commercial substance.
So what?
Apple.
Why not the pink and black is lacking commercial substance? Any transaction which is going to influence the risk, the money, then only it's said to have a commercial substance. If it lacks, then it is not a commercial substance. Okay? They beautifully say the position before and after transfer doesn't change. Yes or no? what I was having was black in color, what I have now is a pink in color. In substance, nothing has changed. My position before purchase and after purchase is one and the same, after exchange is one and the same. Yes or no? This kind of a transaction is called as lax commercial substance. Not necessarily one person have to make a profit or one person have to suffer, or it should have consideration. All that is secondary. Whether your position was same as before, if it is same as before, then it lacks commercial substance. Okay? The fourth condition is the contract should have a commercial substance. If it lacks commercial substance, then it is not a contract.
So, this specific condition lacks commercial substance. Isn't it very subjective? Sometimes it can become very subjective. Right? So for example, you gave a phone color swapping example, but let us assume that I have a 1 acre piece of land, and then there is another 1 acre piece of land right adjacent or maybe very, very close. And then if I swap this piece of land with other piece of land, I'm sure there is a commercial substance. Even though somebody can say that my position before and after this swap is actually the same. But there could be so many other factors that could influence this particular, whether it is a commercial substance or not, is very difficult. Sometimes somebody may say that there is no commercial substance, but somebody might feel that there is a commercial substance. How do we then take care of those scenarios?
Surely. My financial statements is full of estimates and judgments. So from day one, this is what I have been telling. Okay, it's full of estimates and judgments. To answer your question, so to come back to the first question, definitely a plot of a land, a corner plot will have more value than the plot next to it. So here is where that a layman definition which I gave. Did your position change after and the exchange? If it has changed, can you say that if it has changed, then definitely it has a commercial substance. That means that you are supposed to do a revenue recognition. There's something which has exchanged. You do not, what you own now and what you own earlier was a different thing. You have to do a revenue recognition. Okay? So I have a separate slide for the accounting treatment. So let me skip the thing today. Basically, the next question would be, if it lacks commercial substance, what I was having was apple S14 black color. What I'm having now is apple S14 pink color. Definitely there is a change which has happened. From an accounting perspective, what is that I'm supposed to do? From an accounting perspective, I only have to change or give effect in my inventory. Okay? The previous question, what I swapped was a Samsung for an Apple phone. Here, I'm supposed to recognize revenue. How do I recognize revenue? I need to go and check the fair value of the Apple phone. That is going to be my sale value. So that is how I will recognize my sale. Okay? So all the 5 conditions need to be fulfilled. Only if it is fulfilled, then only you can say contract exists. If it exists, then I move on to the other stages. Okay? So let us read this. NW Limited decides to enter a new market that is currently experiencing economic difficulty and expects that in future the economy will improve. NW Limited enters into an arrangement with a customer in that new region for networking products for promised consideration of 12,50,000 at the contract inception. NW Limited expects that it may not be able to collect the full amount from the customer. Okay? Determine how NW Limited will recognize this transaction. So there are few takeaways from this thing. If I have to put this question in a simple terminology, there is a contract which has been entered into for a some consideration of 12,50,000. The entity knows that it will not be able to collect entire 12,50,000 at the inception. Okay? So, can I say a contract exists? Is my question clear? Can I say a contract exists?
Yes.
I am not sure of receiving the full money. So can I still go ahead and recognize revenue, or can I say the contract exists and subject to fulfillment of other condition, can I go ahead and recognize revenue? Can I do that?
Yes.
Okay. If yes, at what value I am supposed to recognize revenue?
The entire 12,50,000.
No.
Uncollectability. If we
Collection
read
is not a criteria for revenue recognition.
Of course, the first line only says that.
collectability is very much a criteria. If I have to, I'll come back to you. The only thing is, I am not certain of receiving 100% of the money. If you read the question, what it says, last but one line, it may not be able to collect the full amount from the customer. I'm not saying that I'm not able to collect the full amount from the customer. So that is where this question becomes relevant. If I am supposed to say that contract exists, to what extent I can recognize revenue?
Estimated cost.
What estimation?
Cost estimate. Probability of collection.
Okay. Very good. The standard says, whenever you say identify performance terms and you should be able to get that money, what it says is it should be probable. You should be probable that you are able to collect revenue. What is probability? What is probability? Remember those old golden days when we wrote exams? Immediately after exam, or how was the paper? What is the pass percent? What is the probability of we clearing the exam? Huh? Probable, more likely than not. If the probability is greater than 50%, more likely than not. Look at the terminology they use. More likely than not. That means the possibility of I collecting that revenue is more than 50%. Then there is a contract which exists, then I can go ahead and recognize a revenue. Now the question is silent. So it only says whether I'm doubtful to receive the full money. What is the probability that I'll be receiving the money? So the probability of receiving that is, say, 60% or 70%. Then I will recognize revenue only to the extent, then the contract exists, please pardon me, then the contract exists. I will recognize revenue. I will not say the answer, but I'll just take up the next question. So let us try to relate this. I'll slightly shift this question. I have sold goods. Customer has given me a check, full check. Okay? Whether transfer of control has happened? Transfer of control has happened. I go present the check bounces. The check bounces. Okay? Is there a contract?
Yes.
Can I recognize revenue?
Yes.
If I can recognize revenue, to what extent I can recognize revenue?
So for the full amount, sir. Because collector, I mean, again, the fact that there is a bad debt doesn't mean that the revenue cannot be recognized.
Yes. Okay. Have I performed my performance obligation? Yes. At that time, I was expecting this, the collectability criteria ensures. At a later point of time, for whatever reason, the check got bounced. So, for answer to both the question, we'll have it discussed now. Even in the first question, I will recognize, subject to other conditions having been fulfilled, I will recognize revenue to the extent of 12,50,000. But to the extent of probability that I am not going to get money based on my past experience or thing, I will make a provision. In the second case also, I recognize revenue in relation to sale of a goods. However, from the receivable, I will make a provision for the possibility that the customer might not pay. Okay. So I will recognize revenue, receivables get established. From the receivable, I will even see whether a provision is required. So that is what is required here. Okay. So the standard talks about few other things, contract modifications. So there's a contract to supply 100 units. There's a contract to supply 100 units of goods. So the entity has supplied, say, 70 goods. The customer suddenly comes and says, okay, contract to supply 100 units of goods for a simplicity sake at rupees 10 per unit. I have supplied 70 units. Customer suddenly comes and says, I need 20 more units. I need 20 more units. Since I have already purchased 100 units, now you'll have to give me 20 more units at a reduced price of 1 rupee. That means at a reduced price of rupees 9. So the thing is this form part of a virtual contract, or is that 20 units can be treated as a separate contract? Okay. The thing is, if the remaining goods or services are separate from an earlier one, even though it is same, the price agreed is totally different. So hence that supply of 20 units would be treated as a separate performance obligation, and I recognize revenue accordingly. Again, if I have to slightly modify, continue the same example. Original contract was to supply 70 units. Original contract was to supply 100 units. 70 units I have transferred. The customer comes and asks me for additional 20 units. He is smart enough and says that, boss, now I am willing to buy this 20 units, provided for the balance 30, including this 20, you will have to supply, you will have to reduce the price to 9 rupees 50 paise. Then only I am interested to buy. Okay? So, this kind of a thing, basically, it is going to impact my existing contract. So I'll have to see whether I need to treat that as a distinct contract, or I need to modify the existing thing and recognize the revenue accordingly. So in this kind of a thing, what will happen? I'll recognize revenue, I'll treat that as a formal part of my original contract, because my original terms and conditions are getting affected. I'll recognize revenue I'll recognize revenue now. I'll ascertain my overall contract price, 17 to 10, 15 to 9.5. So that is going to be my overall contract price. That divided by 120, that is going to be the revised per unit cost of the product. For 70 into the revised price, that is going to be the revenue what I will currently recognize. And for the balance supply of 50 units, I recognize as and when I fulfill. So this effect is called as a cumulative catch-up. Okay. What are the key takeaway of the contract? If the 5 conditions what we discussed in a contract doesn't fulfill, there is no contract, no revenue recognition. If you have received a money, perfectly fine. You are not able to establish a contract, but customer has paid the money well in advance. You treat that as a liability. Contract doesn't exist, but you have received money, which you have to recognize, definitely you recognize as a liability. You will reassess the position at regular intervals. As and when the terms gets fulfilled, then the contract comes into picture, then you will invoke other provisions and start recognizing the revenue. Okay? Only under rare circumstances you can recognize revenue. Basically, so non-refundable advances, in some instances we receive non-refundable. So token money we receive for booking something, and if you don't perform the balancing within XYZ date, that becomes non-refundable, forfeited money. So those kind of a thing can be recognized as a revenue even though contract doesn't exist. But in other cases, I need to recognize that as a liability till the contract terms gets established. And once the contract terms gets established, then I invoke other provisions of India's 115. Okay? So out of 5 steps, first step, which is a contract, out of the 5 conditions, all the 5 conditions should be existing before I move on to the second element. If one of the conditions also doesn't fulfill, then I cannot recognize it as a contract. That means I'll only be recognizing it as a liability and reassess till the other condition gets fulfilled. The second step is basically identify your promises. In the contract, how many promises have you made? In simply put, how many performance obligations are there in a contract? Please remember, all this we are supposed to make or have a clarity on day one, not necessarily as and when the progress happens, we keep modifying. That cannot happen. You need to have a clarity on day one. How many promises, how many performance obligations you have agreed upon as a part of a contract. It is whether it's a single performance obligation or more than one performance obligation. Okay? If goods or services are distinctly identifiable, so again the standard says, whether the goods or services, if it is distinct in relation to one another, then you will have that many performance obligation. If it is not distinctly identifiable, then you treat it as only one performance obligation. Okay? When you will say the goods or services are distinctly identifiable, that means when you will say there are multiple performance obligations. The standard is little conservative. It says that you will have more than one performance obligation if all the conditions gets fulfilled. There are condition 1 and then the condition 2. If any one of this also gets fulfilled, then you will say there are multiple performance obligations. Okay? So, do I have an example? Yes. Let us understand this with two simple examples. We buy, recently there is a promotion which had come. If you buy that new internet connection, Xtel or something, so they were giving Deepavali offer. So in addition to internet connection, you will also be getting OTT services. Okay? A telecom company sells internet connection as well as OTT subscription. We will have two simple examples. Now you tell me, from the telecom company perspective, how many promises are there in the contract? The question is whether I can use the internet separately. Definitely, I don't have to buy the OTT subscription from them. I can basically buy a Netflix subscription on my own. I don't have to be dependent on them. Can I use it independently? Definitely yes. Can I opt in only for an internet subscription? Definitely they have quoted a different price for an internet. For an OTT, and put together that quoted me different figure. Can it be sold separately? Yes. Okay. To buy this internet as well as an OTT, does it require a integration, high level of integration? No such integration. What is required is an internet services. Once they put that cable wire, afterwards, so it is once I have an internet connectivity, either I can choose the OTT subscription from them, or I can buy a Hotstar or Netflix on my own. So there is no separate integration required for this additional OTT subscription. Are they highly interdependent? So both are very much required in together. It is not necessary. I can choose an OTT subscription alone, or I can choose an internet alone. So this kind of a thing, there is a distinct performance obligation. So I will treat the telecom company will treat the internet connection separately and the OTT subscription as a separate performance obligation. In the second example, a company sells a high-end software, customized software with the configuration and integration. So without the help of the entity, I will not be able to configure or I will not be able to customize. So that means the sale of a software plus the configuration is bundled together. So here I cannot treat that as, even though the software and the configuration they are charging me separately, I cannot treat that as a two separate performance obligation. I'll have to treat that as a bundled, only one performance obligation, and accordingly I'll have to proceed further. I'll have to see whether revenue to be recognized accordingly. Okay. Contract, 5 conditions, performance obligation. Amongst the contract, in the contract, how many promises are bundled? Whether it is distinct, if it is distinct, I'll have to take that as a separate performance obligation. If it is integrated, if it's high integration, high customization is required, then I cannot treat that as a distinct, I'll have to take that as a one performance obligation. Moving on, contract, transaction price, contract and performance obligation. The next thing is I need to ascertain what is the price we have agreed for the contract in relation to the promises. The transaction price is basically the purchase consideration. The purchase consideration which has been agreed upon. The standard gives a various alternative or various components which could form part of a transaction price. Quite interesting. First is fixed consideration. Fixed consideration. It says, you want to buy a flat? Okay, yes. This flat is available for sale for 50 lakhs. I'll say, okay, available for sale for 50 lakhs. I'll say, immediately I'm not having money, I would like to pay it in installment. The builder says, okay, you can pay this 50 lakhs in 4 equal installments, but the price would remain at 50 lakhs. 50 lakhs is a fixed contract consideration. Okay. So I'll have to pause this discussion. We'll have to come back and continue. Let us have a coffee break and assemble back in 15 minutes time. Thank you. Can we start?
Sure.
So this is going to be a difficult session now. So earlier few of us were sleeping. Now most of us were sleeping. Okay. Fine. That was on a lighter note. Let us come back. Determination of a transaction price. So, having established, identified a contract, identified the number of performance obligation or the promises as the case may be in a contract. Third interesting or a critical aspect is to ascertain the transaction price. What is transaction price? Simply put, is nothing but the consideration what been agreed upon. Consideration what has been agreed upon. The consideration could involve various things. The fixed consideration, the amount is agreed upon. So whatever might be the ifs and buts, the total amount is agreed upon. So there is no escape. Variable consideration. Variable consideration. Simple examples could be discounts, volume discounts, rebates. I have a separate slide for this, I'll take you through. So I'm just giving a hint of what we are going to discuss under transaction price. Incentives and penalties. So variable consideration is basically which could either increase your overall transaction price or it could even have a negative impact. It can bring down your transaction price. Okay. The other thing is a financing component. Other thing is basically a financing component. Financing component is basically the previous example where the builder has given me a 1-year time frame to make the payment. Okay? So definitely there is a financing, the time value of money which is involved. We'll have to respect that. So even we'll have to see how the aspect will be taken into account. Non-cash consideration. So if you remember, previously also in the contract we said contract should have a commercial substance. Any exchange should have a commercial substance. If it happens to be a non-cash transaction, a barter transaction, how do you establish a transaction price? So that is what we'll have to look into. There are few instances. One classical example is a flat gets sold and the buyer is being provided an offer saying that if you find one more prospective buyer, you get say 2.5% commission. Possible? Very much possible. Where the entity is returning the money to the customer. So these are some of the aspects what we'll have to understand. So under transaction price, we will see how the methodology works under each one of this. Okay. Whenever there is a variable consideration, as I mentioned you earlier, variable consideration could have an effect of increasing the transaction price or reducing the transaction price. Increase is basically when you get an incentive or a bonus, performance bonus. So that is basically agreed transaction price plus incentives. Definitely it is going to be more than that. There is a contract saying that you have to complete the construction by 31st January. If you complete it, say before 15 January, you will be paid an additional incentive of say 5%. So that is a classical example of positive variable consideration. Extending the same thing, if they say, even if you don't complete by 31st March, a 10% amount would be cut as a penalty. So that is going to be the negative side of it. Variable consideration. So in case of a variable consideration, in this kind of a scenario, so please understand what we are trying to do. We are trying to ascertain the transaction price or the contract price at the very inception. I have entered into a contract, say on 1st October, and it is going to get over in January. On 1st October, how do I take into account the variable considerations? How do I take into account the variable consideration? Because the requirement is on 1st October, I need to estimate, taking into account the variable consideration, what is going to be my overall transaction price. Am I clear? My objective is on day one I am supposed to estimate the outcome of it, and that is how I'll be able to have a control over my transaction price. The standard provides two alternatives. One is expected value method, because on October 1st is what I'm expected to do this thing. Expected value method or most likely method. Let us again understand this with a simple thing. One is ABC Limited enters into a contract to install a networking equipment. The consideration depends on the performance speed. So if the performance speed is achieved, so you will be paid, your consideration is going to be 1,20,000. If it is going to give a normal performances, then your consideration is going to be 1 lakh. Now the thing is, sitting today, I need to know what is going to be my transaction price. So whenever this kind of a thing happens, so what I am supposed to do is basically, it is two possibility, expected value method or most likely method. Expected, I'll try to find out what is the probability that the outcome is going to be high performance or the normal performance. It could be 60-40, it could be 50-50, it could be 30-70 as the case may be. Based on that, I'll try to establish my transaction price. In the given example, we have taken it as possibility of 60-40, and accordingly, I'm going to establish the transaction price as 1,12,000 and start doing a revenue recognition. Okay. The second alternative is basically installation. There is a promise to complete a software installation. If installation is completed by 31st March, the customer will pay 80,000. Otherwise, you will pay only 60,000. Okay. Management expects that 95% probability that installation will be completed on time. So, given the two possibilities, should I recognize revenue at 80,000 or 60,000? Since the management estimates that most likely that I am going to complete it on time, then definitely whichever is most probable that I will be completing it on time. So accordingly, I'll take a revenue as 80,000 and start doing an accounting. So this is on stage 1. Now let us extend this discussion. When both in illustration 1 and illustration 2, toward the end, I come to know that, okay, illustration 2, toward the end I come to know that I have recognized revenue at 80,000. Toward the end I come to know that it is not getting completed by 31st March. What is that I am supposed to do? Is my question clear? I would have started doing an accounting, presuming that my outcome is going to be 80,000. But on 31st March, I came to know that it is not going to be 80,000, it is going to be 60,000. What is it I am expected to do? Reverse. Use whitener and do reverse. Change. There is something called as change in accounting estimate. Change in accounting estimate. The only concept which I really admire or I really like is change in accounting estimate. Why I admire is basically whenever there is a change in accounting estimate, initially what we said, financials are full of judgment and estimate. Whenever there is a change in accounting estimate, you are expected to give effect prospectively and not retrospectively. Are you able to understand this? I will not open yesterday's thing. I will only make the changes when the estimate change and proceed further. Change in accounting estimate. Okay? Are we clear? So if at all, at a later point of time, the management estimate is tested and it's proved wrong, then the requirement is only a prospective effect and not a retrospective effect. Prospective effect is from that date onwards. What you can do, you please do it. Don't go back and make the correction entries at an earlier stage. This is called as a prospective effect. Presuming that this is not a change in estimate, but this is on account of a error. Okay? Instead of 60,000, by oversight accountant has wrongly taken as 80,000. Then can I again invoke change in accounting estimate and do prospective effect? No. It requires a retrospective effect. Okay? Retrospective effect is really, I'll have to go back to the original date, recompute its effect and give the accounting treatment accordingly. Okay? To summarize, financial statements are mainly driven by estimates and judgment. The management is expected to make certain estimates and judgment, and at a later point of time, if that is proved wrong because of the change in circumstances or other thing, then the requirement is you can go only with the prospective changes and not a retrospective change. Okay? Variable consideration. So we're still seeing the other aspects of variable consideration. The next variable consideration element could be volume discount and volume rebate. Okay? Volume discount is basically if you buy more than 10 lakhs in a year, you get 5% of additional discount. On day one, will I know whether the customer will buy more than 10 lakhs? Okay? If that is the case, what is that management is supposed to do? Again, the answer is management is supposed to do an estimate. What is the possibility that the overall thing is going to be more than 10 lakhs and do things accordingly. Rebate is basically a reduction in price and the treatment would also be similar. Sale with a right of return, very very common thing, sale with a right of return.
Cash discount is also adjustment to the revenue.
Cash discount, I know it on day one. So this what
If there are like 30 days, I give you 20, something like that. Because there are like effectively not immediately, but yes, if you pay within 30 days or you pay early.
Okay. So the question what is being asked is, where do I give effect of to cash discount? Will I show it as a change to my revenue, or will I show it as a expenditure in my profit and loss account? Can I put this question differently? Is that okay? Okay, where is that effect I am going to give? Should I give effect as a reduction from revenue, or should I treat that as a P&L item?
Reduced revenue.
Okay. So trade discount and those kind of a thing will have an impact of reduction from revenue. So if cash discount is purely subject to payment terminology, that will go into my P&L account, because I do not know what the customer is going to make payment. So you paid within 45 days, you will get say 2% of discount. Paid after 45 days, you will not get a discount. Those kind of a thing. So it will have a P&L. Okay, what we are trying to ascertain is again the components of variable consideration, how it is going to impact determination of a transaction price. One of the common thing is sale with a right of a return. Very interesting. Sale with a right of a return. We book through Amazon, Flipkart, okay, which gives 7 days, 10 days, 30 days replacement guarantee. A return guarantee. Let me not go with the replacement, return. What is return? You just return, you get your fund back. Are we not interested to know how this is going to be accounted? Okay. Any thought how it is going to be accounted? Sale with the returns.
Maybe you will recognize after the window is closed, after this return window is closed.
Then don't you think it will be, see, I am on Amazon, say I am selling through Amazon, you are all customers, each of you would have booked through me. How do I keep a track key when is Mr. X thing is getting over? Okay. Am I correct? Any other logic or reasoning?
Warranty percentage.
Estimate.
We'll go with the estimate. Whatever is there, we'll put a responsibility on management. Boss, you estimate what is going to be the possible return in this kind of a scenario. Okay? Then, I will be recognizing it accordingly. Let us understand this through a case study. ABC Limited sells 1000 units at rupees 1000 each. Okay? Cost being 600. Management expect that in a normal circumstances, 5% of the units would be returned back. Management estimate. Okay? As an auditor, you will have to evaluate that. But from an accounting perspective, let us say that management has estimated in a normal circumstances, 5% of the sales will probably come back. In these circumstances, can we see what is going to be the accounting treatment? What is going to be the accounting treatment? I have a okay. So the total sales value would be number of units into this. Expected returns is 5%, which is 50,000. I will recognize revenue. Only for the 95% which I don't foresee return would happen. So that is my actual sales. For the 50,000, which possibly when you people return back, so an entity has to refund the money back to them. So we'll have to call them something. So we call it as a refund liability. Day one, when the sale happens, I would have received 10 lakhs. I will recognize revenue to the extent of 9,50,000, and I will also recognize a refund liability of 50,000. Okay? I'll not go to the second part of the journal entry. Let us see this. 30 days down the line, or as per the terms, if 5% of the thing comes back, what I will do, I'll have to return the money, bank account gets credited, the refund liability what I would have created earlier will get debited. So that is what going to be the reversal effect. Okay. Now let us see On this 5% of the goods which I have expecting to come back, what is it I am supposed to do? I am also supposed to recognize a right to recover, because at the end of the day, for 5% I am going to get my goods back. Okay? I will also recognize something called as right to recover, right to receive assets. Right to receive assets are basically, can I recognize at its selling price? I cannot recognize at its selling price. So what is the next thing? I have to recognize that at its cost. I will recognize right to recover asset. Please understand, totally 6 lakh worth of inventory are getting removed at the point of sale. So I'll have to reduce inventory to the extent of 6 lakhs and create an asset saying that 5% of this inventory would come back at a later point of time. So that is where I will create a right to recover asset. Are we clear with this? So we'll continue the discussion. Let us see what happens if exactly 5% of the people return the money, will return the goods, or what happens if some other people or other numbers happen. Alternative 1, if actual returns are exactly 5%, which is 50 units. Okay. So how many units? Have I taken it correctly? 1000 units. 5% is 50 units. Exactly that many units gets returned. So I need to pay them money. So my bank account will get reduced to the extent of 50,000. Refund liability, whatever I created, to that extent will become nullified. At the same point of time, I am also getting my inventory back, right to receive asset, which I had created earlier. I will de-recognize right to receive asset and I will recognize my inventory to the extent of its original cost. Looks simple. Now, let us assume there is a change in estimate. Instead of 5%, 7.5% of the people returned. 7.5% of the people returned the goods. What was initially I estimated? 5%. Accordingly, I recognized a liability, refund liability. Now 7.5% of the people are returning. I have to pay the money. I cannot say that I will not pay the money. I will have to pay the money. 75,000 will go from my bank account. I will also nullify refund liability because I have created what I have created 50,000. So I will have to nullify. So the difference of 25,000 will have an impact here. Next, the right to recover assets. I had created only for 5%. Even that has to be reduced. But here, inventory what I am getting is not 50 units. I am getting 75 units. I have to recognize inventory at its cost value, whatever 600 rupees or as the case may be. The difference will go, and because what we said, if there is a change in accounting estimate, the effect will have to be given prospectively and not retrospectively. Whatever effect comes, in the name of God, we will put it to the P&L as a change in accounting estimate. Okay? As a homework, I want you to try what happens if the actual returns are only 25 units. Okay? So who are feeling sleepy, you can try this. What happens, what is going to be the journal entry if the returns were to be 25 units? Quite interesting. And you will find it good amount of time to reconcile or arrive at that number. Okay? So, sales with returns. On the inception, when the sale happens, I need to estimate what is going to be the possible returns, what is going to be the possible return of goods. And accordingly, I will create a refund liability. Since on the return of goods, I will also be getting an inventory, I will also create a right to receive goods. And as and when the return happens, I will nullify my refund liability, right to receive goods, and recognize the inventory at its cost value. The difference, if any, will go to the profit and loss account. So it's a very interesting. Please try what happens if the returns are only 25 units. Sir has started. Let us see.
It's refund to bank and to revenue.
How much will go to P&L account? That is my question.
No, pay the balance. What do you do revenue? You go to revenue. You go to-
Huh. So I want, if you can have the numbers, it becomes easier. I know general entry would remain same, but the numbers is what I am looking at.
5,000?
Yes, in the interest of time, let me continue. We are still discussing the transaction price or a contract price. What are the various elements which could impact or influence your transaction price? The next important thing is financing component. Okay, you have agreed on a transaction price and you have been given a time limit to pay the transaction price. What needs to be done? Okay, again, a general parallels is, if it is 12 months, anything which happens before 12 months, we don't take into account the time value of money. That is a general thing what we do in India is, if any transaction is going to happen within 12 months, then I don't say there is an interest element, or I don't get into the difficulty of ascertaining the time value of money. That is the one common thing. So anything beyond 12 months, I'll have to see whether there is a financing element involved or otherwise. There is an interest element involved or otherwise. In a normal thing, why will someone give you a time limit of more than 12 months to make a payment? Correct? So, whenever there is a additional time frame being given and a contract price agreed upon, the standard expects you to decipher what is the interest element for the delayed payment and what is the contract price. Okay? In other words, there are two promises the entity has made. The first promises is basically a delivery of goods. The second promises is basically extending an additional time frame for making a payment. There are two performance obligations which gets attracted. And accordingly, we are supposed to recognize this. So we basically take a look of financial instruments on recognizing interest, but in principle, whenever there is a additional time frame being given, whether it is expressed or implied, a builder has given me 24 months to make a payment, is nowhere ever anywhere said that interest will be charged on you. Nowhere he has told. But you are expected to take into account the contract as a financial element, and the performance obligation are basically for a transfer of a property and the additional timeline being provided for payment of a consideration. Are you clear?
One question. This delayed payment, so let us assume that the payment terms is that there is an 18-month window for payment. So you see, because it is beyond 1 year, maybe we should consider the present value interest component. But if the industry practice itself is that, where there is a 18-month credit period, maybe it is an aircraft transaction or a large infrastructure project, where the industry practice is giving a 18-month, 24-month credit period, even in those transactions should we separate the interest component, or is it only when it is beyond normal credit terms we have to do this?
Yes. Answer lies subsequently. In general parlance, whenever the time limit is up to 12 months, we don't get into the time value of money concept. If it is greater than 12 months, we take into account the time value of money. There are two questions to it. In general, do we do this or do we have an exception? So that is where we'll come to. And what is the rate of interest at which I am supposed to work out my financial arrangement? Coming to the rate of interest, the standard says is we'll have to go for an incremental financing rate. So incremental financing rate of the entity. If entity wants to borrow an additional fund, what is the rate of interest at which it is getting? So that is going to be the rate of interest what it is expected to charge from the customer. If and only if incremental financing rate is not available, then we'll have to go for an internal rate of return. Okay? Are there any exceptions to it? Are there any exceptions to it? The first exception is if the time period is less than 12 months, so basically we will take a relaxing thing saying that we don't try to establish a interest element into that. Delay for reasons other than financing. There is a requirement that, see, normally for a contract and those kind of a thing, you are expected to pay a retention money or a security deposit kind of a thing. So these, okay. Transfer of goods or services at customer's discretion. So customer himself is, okay. Okay, transfer of goods or services at customer's discretion. So customer is basically demanding this kind of a thing, not the entity. Entity is silent. The customer is trying to work out this kind of a methodology. Or if it were to be an industry practices. Under these circumstances, I may not ascertain the financing element and try to segregate separately from my overall transaction price. Okay? Again, a financing component, very interesting question. It could be two ways. One is entity providing an additional time frame. Yes or no? Entity providing an additional time frame. Or customer providing an additional time frame. Customer will come, even though he is expected to pay at a later point of time, he comes and voluntarily pays the money in advance. Okay? Then also you are expected to work out. Okay? That means we need to decipher the interest element and treat the interest when the customer or whenever there is a time lag involved, we need to separate the interest element from the transaction, right? And treat that separately. Okay? However, when there is a timing difference is less than 1 year, we may not do this.
Is this again that, how do we treat, like, is it again that same cash discount kind of thing, that he pays it early and asks for a discount?
No, out of my contract overall transaction price, say presuming that my rate of interest is 8%, I do a reverse working. If my contract price is 1 lakh, I do a reverse working and say if it is, I have a timeline of 3 years. So then my interest component might work out to 12,000, imaginary number. I will recognize a revenue on say 88,000. This 12,000 will be treated as a deferred revenue to be spread across over a period of 3 years as an interest component.
What I'm talking about is the customer comes early and asks that you give me 12% discount, I pay you today.
Then that is a variable
The
component.
second question, when you said that the customer comes and asks me, is that a finance, like advance payment, what you said in the second instance here?
So basically, we have to recognize this time value of money not only from the entity perspective. If entity also is receiving money well in advance, even then we are expected to ascertain the possible interest element inside that.
So how do you treat that? Let's say in the same case, we were supposed to pay 1 lakh after 3 years. He came today and gave me, said you take 88 and take today.
Correct. Again, I work backwards and see if I were to pay 8% interest on this amount for a period of 3 years, what is going to be that amount?
So I will reduce my revenue by 12%?
Yes. And treat that as my interest expenses.
Interest expense. I am debiting my revenue by 12. Then again there will be a debit to interest?
No, in this case, I'll be hiding my revenue. Sorry. I think I have a slide where I have put a question on that.
Okay.
I'll have to increase my revenue. Sorry, I told it otherwise. I'll have to increase my revenue because I got the money well in advance, and I'll also have to recognize my interest expenses, which I am paying to my customer.
Okay, we'll wait for the side.
So I think first we need to understand the operating cycle condition.
Whatever is the operating
Generally, standard talks about 12 months. We may have an industry
Right,
where the
right.
operating cycle is 4 years. For example, in infrastructure. So these all things differ depending upon that's what the industry standard is nothing but operating.
There is no debate on
Now, his question, very valid question. I should have had a number. So normally, what we consider is financing element only from an entity perspective. because the entity has provided an additional time frame for repayment from a customer. There could also be a possibility that entity is under advantage, that it is get, so that is where the standard requires even that need to be taken into account. Okay, barter system. So this is where we started. So one of the interesting criteria is a transaction should have commercial substance. We understood that in the previous discussion. Only when a transaction has a commercial substance, what do you mean by commercial substances? Which changes the economic position, risk or a cash flow. That is when you say a transaction has a commercial substance. In a very, very layman terminology, if after a sale and before a sale, if your position doesn't change, then it is said that it lacks commercial substance. Only if you are in either an advantageous position or a disadvantageous position, then it is said to have a commercial substance. Okay, only those transactions which has a commercial substance have to be looked into. If it is not having a commercial substance, how the treatment has to happen. In the previous example, let me continue the same previous example. Apple S14 pink color got exchanged for a black color. Okay, so that was one example what we took. It lacks commercial substance. The accounting treatment is basically, I'll have to change only my inventory. What was there earlier has gone out and what is there now is a new thing. No impact as far as revenue recognition is concerned. However, a Samsung phone is getting exchanged for an Apple phone. A Samsung phone is getting exchanged for an Apple phone. Now the question is, from an entity perspective, what is going to be the revenue? The standard says is, fair value of the asset need to be established. Fair value of the asset need to be established, and accordingly revenue need to be recognized. What is the order? So again, an interesting question. Entity Samsung is getting exchanged for an Apple phone. Now what is going to be the fair value for the entity? Is it going to be my product, fair value of my product, or fair value of the product which I am receiving? We'll understand this through an example. Is my question clear? If an entity is doing a barter system, the question is what fair value need to be adopted? The fair value of the asset given away or the fair value of the asset which is getting received? Which fair value need to be considered for revenue recognition? Received or given away?
Received.
You have to take into account the fair value of the asset which I am getting. That is going to be the revenue. Okay? So, with a very simple thing, A Limited, which is a telecom company, entered into an agreement with a B Limited, which is a power transmission company. An agreement saying that A Limited will provide 1 lakh minutes of talk time to the employees of B Limited in exchange of getting power for 20,000 units. A Limited normally charges 5 paise per minute of talk time and B Limited normally charges 2 rupees 40 paise per power. So what is going to be the revenue for A Limited? Revenue is basically the fair value of the asset what I am receiving. A Limited is receiving a power. So how much power it is receiving? 20,000 units. So the fair value of 20,000 units at 2 rupees 45 per unit will be the fair value for revenue recognition. And for P Limited, what is it getting? It is getting a talk time of 1 lakh minutes. 1 lakh minutes at 50 at 50 paise per minute, then that is going to be 50,000. So that is the value at which revenue have to be recognized by A and B Limited respectively. We started understanding the contract, the 5 ingredients to the contract. Only when all the 5 ingredients are there, we take the contract as granted. Then we'll move on to ascertain the performance obligation, basically the amount of the number of promises in the contract. The third one is to know the transaction price. What is the overall contract price? Having ascertained the number of promises and the overall transaction or contract price, the fourth step is basically I need to allocate the transaction price to the various performance obligation in a contract. if I have to say this in a simple words, a contract was entered into for 2,50,000 with a client to complete both the statutory audit and a tax audit. So contract is basically in relation to performance of a tax audit and a statutory audit. Performance obligation is basically two performance obligations. One is tax audit, one is statutory audit. What is the transaction price? Sum total, which is 2,50,000. Now the fourth question would be, how do I allocate this 2,50,000 between tax audit and statutory audit? That is what we will be looking into. The fourth thing is, if a contract has more than one performance obligation, how do I basically allocate the transaction price? How do I basically allocate the transaction price amongst multiple performance obligations? The standard gives a crystal thing saying that you can follow something called as a standalone selling price. What is standalone selling price? The price at which entity would have sold its product on a standalone basis. If the client would have come to me for a tax audit, I would have quoted say 1,50,000. For a statutory audit, I would have quoted a 1 lakh. So that is going to be the standalone selling price. That will be the basis for splitting the transaction price amongst the various performance obligations. Okay, so they want the standalone selling price to be a basis. If for whatever reason standalone selling price is not there, then you can use other approaches, which is basically cost plus margin approach or a residual approach, as the case may be. Now the question is, not necessarily all the time my standalone selling price and my transaction price matches. If it does not match, how I am going to do this? In the same example, if I have to continue, my tax audit standalone price would have been 1,50,000. My statutory audit standalone price would have been 1,25,000. So together I should have charged 2,75,000 to the client. But since the client came and negotiated, I offered both the services for 2,50,000. Okay. The question is, now, since there are two separate performance obligations, how do I split this 2,50,000 between my tax audit and statutory audit? Okay, so that is what we'll have to look into. Now, I should have charged 2,75,000, but instead I have charged 2,50,000. Okay. Definitely the customer, the client has got a discount. How do I allocate that discount? How do I allocate the discount amongst my performance obligation? So first we need to ascertain what is going to be the discount. So the discount is basically the sum total of the standalone selling price of my performance obligation minus the transaction or the contract price what we have agreed upon. In the given case, I should have charged 2,75,000, but I have actually charged 2,50,000. That means there is a discount of 25,000. The requirement is this 25,000 need to be split between tax audit and statutory audit in its ratio, which is nothing but a standalone selling price. So this 25,000 again have to be split in the ratio of 1.5 and 1.25 as the case may be. Okay, so once we split the transaction price, so I know how many performance obligations I have committed. I know what is the transaction price in relation to each of the performance obligation. As and when the performance obligation gets completed, I need to recognize revenue. Here comes the interesting thing which we all started with. To recognize revenue in Accounting Standard 9, I would have looked for transfer of a risk and a reward in relation to the ownership of an asset. But here we will be looking for transfer of control. When the transfer of control happens, that is the time an entity would recognize revenue. when it is deemed as a transfer of a control, when I have economic benefit, when I have the ability to derive an economic benefit from the usage of an asset, that is the time it is deemed to be transfer of control, and accordingly, whenever a transfer of control happens, that is the time I will recognize a revenue. Okay? So indicators which indicate that there could be a transfer of control is when there is a transfer of significant risk and reward, or customer has given a consent for accepting the goods or services, or the legal title of the asset has been transferred to the buyer, or transfer of a physical possession of the asset, or the entity has got a right to demand the payment for asset. So these are some of the indicators which will establish whether a transfer of control has happened or otherwise. Now an interesting thing, whether the transfer of control, whether it happens at a point of time or over a period of time, whether it happens at a point of time or over a period of time, the standard, again, on a conservative approach, disregards recognizing at a point of time. It always gives preference for recognizing revenue over a period of time. Okay? So that is where the chart comes into picture. When it says, even if any one of the condition is fulfilled, I will recognize the revenue over a period of time. If none of the conditions gets fulfilled, I will recognize at a point of time. I will explain this with a method of measuring. I will come back to it. Yeah. Okay. The standard expects that the revenue recognition should actually be recognized over a period of time, basically applicable in case of the service sector, and discourages to recognize the revenue as a point of time. Okay. Now the question is, if I am recognizing revenue over a period of time, okay, if I have to recognize revenue over a period of time, then what is the methodology I need to follow? Two simple methodology. One is my output method, which is basically what is the percentage of work I have completed. If I have completed, say, 40%, so that is going to be my revenue recognition. That is going to be the output method. Input is basically the cost method. For a completion, if my total cost is 1 lakh, if I spend, say, 30,000 rupees as on date, what is going to be the percentage of completion method and input method? My percentage completion would be 30%. Whether you are following an output method or an input method, you are expected to follow things consistently. If you have any abnormal losses, which is basically what we have been learning from day one, if you have any abnormal losses, those abnormal losses will have to be excluded. If you have any unused material, even that will have to be reduced from the cost, because you have not actually spent that. Even that will have to be reduced. Any method you follow will have to be applied consistently. Let us have a quick recap. Contract. First, there has to be a contract. Out of the contract, you need to establish how many promises are bundled in the contract. Once you establish the promises bundled in the contract, then you will have to go and see what is the total contract price or consideration agreed upon. From the total contract price, you need to allocate it to the respective performance obligation. Once that is done, as and when the performance obligation gets completed, you will recognize revenue. How do you ascertain the completion of performance obligation? You will recognize either at a point of time, over a period of time. If you are recognizing it over a period of time, definitely you need a basis. That basis could be either an output method or an input method. Okay? Yes. So we have few cases to understand this, and then we'll actually move on to real life scenarios. Sale under repurchase agreement. Sale under repurchase agreement. Okay. I have entered into a contract with the customer for a sale with an agreement to repurchase at a later point of time. Okay. An agreement to repurchase at a later point of time. Can we? So now please help me. How do I recognize revenue in this? How do I recognize revenue in this? Sale under repurchase. Same sale, I'm going to repurchase at a later point of time. If I have to give you a simple example, Tata Motors is selling a vehicle, 10 lakh worth of vehicle, and it says that 3 years down the line, I'm going to repurchase it for 6 lakhs rupees. Possible? Very much possible. It's a sale and repurchase agreement. Now you please tell me, how does Tata Motors recognize revenue? Estimate, okay. What is estimate involved? So I have all the numbers in front of me.
They means customer may sell or may
If
not
the contract itself is to repurchase,
Oh, that's okay. There's a
that is
100% guarantee.
that's a 100% requirement that I'll buy back after 3 years. It's not an option, it is a contractual terms.
Differential value. Differential value.
Differential value, okay.
No, purchase at fair value. Sale at full value, purchase at fair value.
Sale at full value, purchase at, okay. So let us imagine how does my PN trading account look like. So trading account will have a sale and I'll also have a purchases.
Correct. Because inventory has gone out and inventory has increased after
But that
3
is in
years.
future. 3 years later, there is a purchase agreement. Today, I am selling a car, and I have entered into a forward agreement to buy a car, buy the used car 3 years from now. So, I don't think there is at the point of sale. Maybe there is no requirement to account because I really don't know the condition of the car when I purchase. Whether I make a profit or loss on that transaction is something that I am not aware of.
Fine, 3 years, I agree with you. If I enter into for a 15 months or 18 months term,
Still the same. Or maybe based on the past experience, I'll have to account for that forward transaction based on my past experience, whether I make profit or loss.
I'll come to Tata Motors little later. I have a slide, so I'll even show you how the recognition happens. First and foremost, we'll have to go and see whether there's a transfer of control in reality happening. Are you actually doing a transfer of control, or is it a financial arrangement? Is it a financial arrangement? If it is a financial arrangement, then I am safe. Why I am safe? 115 is not applicable. That's why I am safe. I have sold something for 10 lakh with a contract in writing to buy back at 11 lakh rupees. What is this? It's a loan or a financing arrangement. Yes or no? If I were to borrow a loan, how much I would have paid? I would have definitely have to pay an interest. Okay? So it is more of a financing arrangement than of a revenue recognition. Okay? Can we continue this discussion? I sold this asset, an agreement to repurchase at 9 lakh rupees. Don't say this is a financing arrangement. Where is the interest? Who is paying interest? Am I clear? For 10 lakh, if I have to repay 11 lakh, definitely 1 lakh additional is an interest expenses. Yes or no? For 10 lakh, today's sale, if I am agreeing to rebuy at a 9 lakh rupees, where is the interest element coming?
The asset is being used, for that there is a cost.
included with the repurchase will exceed the purchase price.
No, the contract is between me and you. We can agree on anything, right? So as per the terms of the contract, I have agreed to sell a goods for 10 lakh rupees with a clear understanding that I will buy it back 12 months down the line for 9 lakh rupees. Can we enter into that? Does it have commercial substance? Is it a contract?
Is this
More like a lease
operating-
agreement.
Is this an operating? More like an operating lease?
Whether in the ordinary course of a business, can I invoke 115? Can I invoke 115? The question is, you can invoke 115 when there is a transfer of control. Whether the transfer of control has happened or not. Okay? If the transfer of control has not happened, then 115 would not be applicable. Then I'll have to search for other standard. The other standard which actually suits is lease accounting. Okay? So it looks more of a lease transaction when I'm selling to repurchase at a lesser price. It looks like a lease transaction and I'll have to take help of 116 to do the accounting. 115 would not be applicable. Again, with a caution, with a caveat that transfer of control is not happening. If a transfer of control happens, then we'll have to see other aspects and ascertain my total contract transaction price and do an accounting accordingly. Okay? If a transfer of control does not happen, I am selling a goods with an agreement to buy back at a higher price. Definitely, that's a financing element. I sell the goods with an agreement to buy back at a lower price. It's basically a lease arrangement. Okay? Bill and hold. Bill and hold. Okay? A customer, okay, let me put it in a very, very simple terminology. The transfer of okay, I'll use that as a question. Customer has purchased goods, paid the consideration, I raised an invoice. Only thing is, customer has not taken the delivery of goods. Is the question clear? Bill and hold. Okay? Please help me. Will 115 be applicable in this case?
Yes.
You have to see whether control has been transferred or not.
We'll have to see transfer of control. So, who is holding? Why am I holding the goods? I am not holding according to my whims and fancies because the customer has asked me to hold the goods on his behalf. Correct? So, transfer of control has happened. The contract is there. We'll have to go and see bill and hold. Definitely there is a contract, 115 is applicable. How many performance obligations are there in a contract? We'll have to check this. The thing might be the customer might not be having a warehousing. He is basically taking warehousing facility from me. He is asking me to hold for a period of time. So I'm holding it safely for him. What is it I'm doing? I'm basically doing a safekeeping for him. Warehousing facility for him. If that is the case, two performance obligations. One is sale and one is warehousing facility. And I may have to split the transaction price between the sale and the warehousing facility and the case may be. Yes? Principal and agent. Principal and agent relationship. Okay? Principal and an agent relationship. Again, Tata Motors. Very fond of Tata Motors. I have been following Tata Motors on a lighter note by investing in its shares. So that's why I'm very fond of Tata Motors after its demerger and fall in price. Okay. Tata Motors is selling a vehicle for 10 lakh rupees. In addition, it is also basically it will also facilitate insurance for the vehicle being sold. Am I clear? Is the example clear? Sale of a vehicle with insurance. Are you with me? Yes, no? This is important to understand the principal and agent. Tata Motors selling a four-wheeler is doing it as a principal. Tata Motors selling the insurance is doing it as an agent. Are we clear? Insurance, that might be like United Insure or some other insurance, it's only facilitating. Okay? And accordingly, Tata Motors will recognize revenue in relation to sale of a car, and it will recognize commission income in relation to sale of an insurance. You will understand the difference? A principal will always recognize revenue on a gross basis. Agent will recognize revenue only on a commission basis. Presuming that in that transaction, if a Tata Motors is getting a commission of whatever, 4,000, 10,000, that is going to be the commission. And for a sale of a vehicle, it will have a revenue recognition on a gross basis. So again, you will have to see an entity whether it is performing as a principal or whether it is performing as an agent. Are we clear? Contract assets and contract liability we have dealt in detail in the earlier discussion, so I will skip this for a minute. Hope you remember contract asset, unbilled revenue, billed revenue. Incremental cost to obtain a contract and cost to fulfill a contract. Incremental cost to obtain a contract. Say for example, you are supposed to pay a commission. Without that, you may not be getting a contract. That's an incremental cost to obtain a contract. What is incremental cost? Without that, you will not be able to get a contract itself, or expenditure being incurred to get a contract. Cost to fulfill a contract is basically an expenditure incurred in relation to performance obligation. Okay? How it has to be treated? With respect to incremental cost, what the requirement is, if just see whether you can capitalize it, because through that you are able to get a contract in relation to supply of goods or services. See whether it's a right what you are getting, and accordingly you can capitalize and amortize over the duration of your contract. Basically, if you capitalize, it has to come back to my P&L account. I cannot keep everything in my balance sheet. So, see an appropriate method of transferring it to P&L account. The appropriate method could be the tenure or the fulfillment of a contract or supply of a goods or services in relation to a contract. Contract fulfillment is basically an expenditure in relation to contract performance. So again, what it says is, if it is less than 12 months, then I don't have to amortize or transfer it over a period of time. I can just generally push it to the P&L account. If it is greater than 12 months, then you see a rationality of transferring it to P&L account. The end requirement is whether it is a contract fulfillment or a contract acquisition cost. It has to be charged to the P&L account in proportion to the performance obligation. So that is the requirement of this. Warranties. Warranties, again, two types. One is assurance type warranty, one is service type warranty. Okay? Assurance type warranty is basically you buy any electronic items. Okay, fine. You buy say 50-inch TV. They say first 1 year warranty will be included in that. In over and above, if you want to buy, so you might have experienced it or you might have tried it on your own. In addition, you can also buy or 24 months or 36 months of additional warranty as a case may be. Are we able to understand this example? Along with an electronic item, there comes an inbuilt warranty period. Over and above the warranty period, if you want, you can even buy an additional service warranty. Okay? The first one is basically an assurance type. Okay, it so happened that, again a personal experience, I had bought a TV from a Flipkart. It had come with an assurance type warranty, that 12 months warranty it had costed. It had come with a 12-month warranty. I paid an XYZ sum of money for that. My bad luck or otherwise, exactly after 12 months, something went wrong with the TV. So this is a assurance type warranty. Having learned from my experience, next time what I did, I purchased another TV. In addition to that, there is a service provider who was providing an additional 24 months services over and above the 12 months for an additional consideration. So that is called as a service warranty. Are we clear? Assurance warranty and a service warranty. Assurance warranty, that warranty which is inbuilt, is very much part of the cost of the product. So there is no separate performance obligation. You will not split that between goods and services. However, the service warranty, there is a separate performance obligation. One is transfer of a goods and one is the additional service warranty. You will have to split the transaction price between the goods and the service warranty and recognize accordingly. Am I okay with this? The bottom line is, assurance type warranty, you don't recognize it separately. Service type warranty, you will recognize it separately. For assurance type warranty, if I am not recognizing, the service provider is not recognizing, what is he expected to do? He is expected to recognize or make a provision in relation to rebates. Because if a customer comes back to him in 12 months for any defects or a service related issue, he has to do it free of cost. So management will estimate what is going to be the possible, management is going to estimate what is going to be the possible cost, and accordingly it will make a provision for rebates. That is with respect to assurance type. For a service type, he will not make a provision for possible rebates. As and when rebates happens, he will just debit directly to the P&L.
This will go in top line or expense?
It depends what is your ordinary course of business.
No, if it's an inbuilt contract, is it an adjustment to the sale value or a P&L expense?
If it is an inbuilt contract, I will have two performance obligations. One is sale of my TV, the second is sale of the service warranty. So there is a two separate.
P&L, top line impact.
Okay. So how did the discussion go? We understood contract, 5 elements to the contract. If all the 5 elements happen, then I can go to the next stage. Next requirement is I need to ascertain how many performance obligation. Once I ascertain performance obligation, the third thing is ascertain overall transaction price. The fourth is splitting the transaction price to the performance obligation. And the fifth stage is as and when the performance obligation gets completed, I recognize revenue. So we'll have some real life instances. Entity XYZ Limited, there is a total contract value which is 10 crore. 10 crore consists of ERP license. The component consists as follows. ERP license 6 crore. Implementation 2 crore. 2 years support. In addition to implementation, it is also providing me 2 years support, 2 crore. Okay. Now can we see whatever we have learned? Can we apply that and see whether we are going in the right direction? Identify a contract. Please identify a contract. The supply of an ERP along with maintenance itself is a contract. Contract does exist. Identify the number of performance obligation. 3 performance obligation. One is ERP license. The second is basically implementation, which could happen instantly. And the third is 2 years support maintenance. Determine the transaction price. The overall transaction price is 10 crore. Fourth stage is allocate the transaction price amongst the performance obligation. So since sum total of it is 10 crore, I will not be accounting for discount or other thing. So I will directly take license at 6 crore. implementation 2 crore, support at 2 crore. When will I recognize a revenue? I will follow for ERP sale, point of time, because it has transfer of control happens at a point of time. Implementation as and when I complete it, so percentage of completion I follow. Support also percentage of completion. Let us see how will I recognize revenue. In the first year itself, I recognize ERP license. Implementation, presuming that, so it should be 100% completion, just for the sake of showing ourselves, 60% in first year, 40% in second year. So 60% I recognize just to show that how the revenue gets recognized. 60% in first year, 40% in second year. Support evenly spread over 24 months. So 12 months for first year and 12 months for second year. So this is what I would have recognized revenue under Ind AS 115. If it were to be accounting standard 9, I might have not got into this headache and I might have recognized the entire amount of 10 crore on day 1. On day 1 only, I might have recognized the entire 10 crore. Okay, so I have few more case studies. You can let me know when time is good for us to wind up. So till that time, we can. Fine. Telecom industry. Okay, telecom industry offers a bundled plan, a smartphone with 30,000, 12-month prepaid plan. Again, a 12-month thing comes at 12,000. If I were to buy it on a standalone basis, it would have costed me 42,000, but I got it at a bundled price of 36,000. Okay, can we apply our learning principles from 115? Whether there is a contract, how many performance obligations, what is the transaction price? Transaction price in this case is 36,000. The question is, how do I split the transaction price amongst the performance obligation? And when will I recognize revenue? Are we clear? Identify a contract. So, contract to buy a smartphone with a prepaid thing. Performance obligation, smartphone with a prepaid thing. Determine the transaction price, total 36,000. The question is, how do I split 36,000 between phone and a 12-month prepaid plan? So basically, we will go with the splitting based on a standalone selling price of my mobile phone and the 12-month plan. When will I recognize revenue? Smartphone at a point of time, because transfer of control happens at a point of time. Prepaid plan, I will recognize evenly over a period of 12 months. Same thing I put. So smartphone, 25,714. 12-month plan, every month I will be recognizing 857. So in total, I will be recognizing 36,000. Real estate, quite interesting. Okay, there is a developer constructing an apartment complex and he has sold a unit as follows. Price of each unit 50 lakhs. Okay, agreement is signed on January 2025. Possession to be given on December 2025. Okay, possession to be given, I think it should be 2026, please pardon me. Possession to be given 2026. Payment term 5%, so 5 lakh upfront, and the balance will have to be paid in installment during the construction period of 24 months. Okay, construction progress evenly spread over 2 years. How will you ascertain the revenue in relation to this? Very, very realistic example. Any thoughts on this? Friends, any thoughts on this? Should I apply at a point of time or over a period of time? For a real estate, should I apply basically a phased manner of revenue recognition, or should I hold on till the entire work is completed? Any thoughts on this?
It's a percentage of completion.
Percentage of completion.
Based on percentage of how much you have completed, the civil activity plan.
Huh.
To that extent you will, because the payment annual is based on the milestone. How the payment, that's a different track. But based on the construction you and the input what you have done, you can decide the payment.
If you are okay, I'll take 10 more minutes. Okay? Difficult. Okay, I'll slightly modify this question. You see newspaper advertisement, a 30-40 plot available at Devganli for 12 lakh rupees. Okay, where you are expected to pay 10% upfront, balance over 8 equal installments. Let us replace this example with the same thing. 8 equal installments, and the possession will be given after 24 months. Am I clear? So now you tell me from the developer perspective, when we will recognize revenue?
If the plot is ready for registration, what is the question of giving 24 months?
24 months for payment terminology. We might be wanting to do a development or getting a permission, blah blah, for whatever reason.
Then percentage of completion basis.
Okay, very interestingly, we'll have to see when the transfer of control happens. When the transfer of control happens, in either of the cases. In this case, normally, will the customer get a right to make a modification? As and when the flat is getting constructed, will the customer get a right of modification? That means you can go, have the furnishing done, have the alterations and those kind of a thing done. So that becomes an interesting criteria, when will the transfer of control happens. Okay? There could be two possibilities. One, that along with the construction, the customer might get a transfer of control. Yes or no? That means he is allowed to do furnishing and other things parallelly, so that by the end of 24 months, when the flat is ready, he might have also done his other activities. So the transfer of control has happened much before. In the other instances, which is very unlikely, where we say that nothing doing, I will construct, give it to you after 24 months. You do whatever you want after 24 months. That is, transfer of control happens at a later stage. Am I clear? So this is where my second example is relevant. When I wanted to buy a plot at Devganli, I don't know which plot I will be allotted. Sir, are you with me? I don't know which plot, which site I will be allotted. That I will come to know only after 24 months. So there I cannot say transfer of control has happened much earlier. Okay? In those kind of a scenario, the revenue recognition should happen at the last stage. Which scenario? When the customer gets a control after 24 months. Even the builder has to recognize revenue at a last stage. If a customer is getting control over a period, saying that along with the construction, if we actually do a construction or do some modification, furnishing and other activity, then the transfer of control is happening over a period of time. The builder can also recognize revenue over a period of time. Am I okay? Slightly thing, but you will have to invoke your transfer of control and see when that will help the builder to determine the recognition of a revenue. Interesting thing, I'll just try to cover and help. Okay? So now the deadline has been extended. All of you will be planning for a 3 to 4 days trip. Okay? So, sir would have booked a hotel at Goa. So let us see. So we are not interested with the sir's expenditure. We are interested with how the Goa hotel will recognize revenue. Okay? A luxury hotel offering a 3-night package. The standalone selling price is as follows. Room stay 15,000 per night. Complimentary spa treatment. So if you was to buy alone, it would have costed 6,000. Complimentary breakfast, which is standalone price of 3,000 for 3 days, like 1,000 for each day. So to put together, it might come to total 15,000 into 3, which is 45,000 plus 6,000 plus 3,000. That would have been my total thing. But the entire thing, hotel has sold it to sir for 42,000. Okay. So please understand, we have to go and check how the hotel will recognize revenue out of this. Okay. So there is a discount element involved. Yes or no? So first, what is the thing? Is there a contract? Yes, there is a contract. How many performance obligation? 3 performance obligation. Stay, SPA and a break first. The thing is, how do I split my performance transaction price to the performance obligation? I will have to take the standalone selling price. So I will be getting that. And when will I recognize revenue? Room stay, I will recognize revenue after each completion day of a stay. SPA treatment, please remember there is only 1 day SPA treatment, not all the 3 days. Only one SPA treatment is what is being thing. He may consume it on day 1 or he may consume it on day 3. That is his choice. As and when the consumption happens, he will have to recognize. Breakfast, as and when at the end of each day, the breakfast revenue will get recognized. A hotel will recognize revenue as follows. The first night, it will recognize 11,667 each day for room stay, 778 for breakfast each day, and 4,667 which is a SPA treatment, as on the day when he basically consumes it. We can make this interesting. What if sir is not keen to take a SPA treatment? Sir doesn't consume SPA treatment. What will happen?
At the end of third day.
No, sir is not keen. He doesn't want SPA treatment.
After the
package
customer checks out,
Yeah.
then the obligation is not there for me to hire.
The question is, will the sir get a refund of that or what? So if sir is not getting a refund, so it's only a matter of time when I will recognize the revenue. So it will be recognized at the end, on the third day. Okay, I have 2 more slides. I think in the interest of time we can wind up. This anymore will be made available. Thank you. Thanks to each one of you. Thanks for the participation. Have a wonderful evening. Thank you.
Thank you, sir. Thank you for your wonderful address. I think so. It was really interesting for you guys. I request Lakshman sir, please hand over a moment to the sir. Please. Sure. Camera is. Let's have a round of applause, sir. Thank you all, thank you one and all. And again, we have a happy days for next 7 days for filing the returns. Thank you once again.